All right, folks, welcome to this presentation. How to trade the next Fed announcement, what an interest rate cut could mean to your trading. I'm Dan Passarelli, and I'd like to make sure you can hear me. If you can, please go to the Q&A box and let me know, will you please? Give me a big old yes if you can hear me. I know there's a slight delay. Hey, thank you, Jesus. Much appreciated, my friend. Excellent. All right. Now, let's see here. Before we get started, I need to point out that options are not for everyone, and you should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. For those of you who are not familiar with me, my name is Dan Passarelli. I'm an author. I'm an author of two popular option trading books. I am a trader. I've been a trader for a long, long time. That's how you get a gray beard like this. I traded professionally on the floor of the Chicago Board Options Exchange, and now I trade in my own personal account. I am the founder and CEO of Market Taker Mentoring, which is the global leader in option trader education. And I'm a trading industry collaborator. I've worked with basically every major exchange in the world, options trading exchange in the world. I work with some of the best brokerage firms like Firstrade here. And I'm a family man. I have my wife, Kathleen, my two kids who are grown, Sam and Isabel, and two really cute little puppies. And I like to do some fun stuff. I'm a runner. I've run a couple of marathons, three out of six of the majors thus far. I'm a foodie and traveler. Me and my family and work colleagues, we've been kind of all over the world together. And I really like music. I'm a musician. I play some music, like listening to music. It's been a big part of my life. So enough about me. Let's talk about the important matters at hand here. In about a week, for those of you who are watching this live, on Wednesday, September 18th, at 2 p.m. Eastern Time, it's a big deal. This is the most important Fed announcement in decades. No joke. And there's a lot of talk about, will the Fed cut interest rates? And we're going to talk more about why that is and what that might mean and et cetera, in just a second. So the last time interest rates were cut was as a result of COVID. March 3rd, leading right up into it, and then March 16th, very, very aggressively, once the proverbial doo-doo hit the fan. That's the last time interest rates were cut. Before then, they slowly started cutting interest rates from a high, and that was in 2019. That was 5 years ago. 25 basis points, 25 basis points, 25 basis points. Now, since then, there have been some interest rate rises. Why? Because, well, interest rates, here's the deal. If you're not really familiar with why the Fed cuts interest rates, well, I'll get to that in a second. So there were, let's see here, starting March 17th of 2022, 25, 50, 75, so that's 1.5, 2.5, 3, 4.25, 4.5, 5.25 basis points. Basically, we went from 0 to 0.25, which is where this started, up to 5.25 to 5.5. And they always give a range because they can't set an exact target. There is some flow that has to do with supply and demand and such, but they keep it within that range. Now, why cut interest rates? All right. So here is what is essential to understand if you're going to be thinking about trading the Fed announcement and you want to be educated about it. So the Federal Reserve, as it stands, has a dual mandate set by the government. And there's two things that are kind of related: price stability and maximum employment. So imagine that you are starting a business and maybe it is a restaurant or a factory or something. Well, if you start a business, you need working capital, right? And sure, if it's a super small business, you can bootstrap it and just use some of your personal funds. But most businesses need to borrow money to get started, and they need bridge loans time to time. And if they have big projects, they need to borrow money. And the cost of borrowing money is the interest rate. So when interest rates are high, it is more difficult for businesses to run profitable. And what do businesses do then? If there's not much profitability, they're able to make less money because their borrowing costs are so high. Well, obviously what happens is the CEO takes a big pay cut, right? No, that never happens. That is one thing that absolutely never happens. What they do is they fire the little guys, right? Let's be real here. They trim their staff. And so these things are kind of related. Let me relate this to price stability now. So that's sort of when interest rates are high, what happens? It contracts the economy by businesses making less money, able to pay fewer people. But what about when interest rates are low? Well, then these businesses, they can borrow lots of cheap money. When interest rates are close to zero, I mean, don't get me wrong, that's a slightly different rate than what companies borrow at. We're talking specifically about the discount rate when we're talking about the federal funds rate. But when interest rates are very low, that's better for businesses. Businesses can be more profitable because they can borrow cheaper money and they can pay it back more easily. And so then they can hire more people. And when there's more employment, then society as a whole has more money. And they can go out and they can buy more things. In fact, they can pay more for things, right? Like if if you are at least middle-aged, you've probably had periods in your life where, things were really tight. You had to eat some ramen noodles and, salami sandwiches. And maybe you had some good times where you're like, man, this is pretty good. I'm flush with cash. I'm going to buy that expensive thing. What it costs, it's not on sale. That's okay. I'll pay that. I've got that extra cash. So what that does is that allows businesses to say, wow, man, business is booming. I'm going to raise our prices. People are going to keep buying it anyway. And that is inflation. That's inflationary. So this price stability and maximum employment, they're like kind of two sides of the same coin. When the economy is going great, that can cause prices to go up. When the economy is going poorly, that causes less employment. So it's this balancing act that the Fed has some input on. Now, exactly how much input they have is kind of up for debate a little bit. I think a lot of people, especially the Fed, believes they have a great deal of influence on this whole little process that I just described. And clearly the market does too, because when it looks like the Fed may cut interest rates, what happens? The market goes up. Why do stocks go up? Well, stocks go up because people are buying them. But why do people buy them? The people who are value investors, they buy them because they're pricing in expected future earnings, right? So people see, hey, if we expect the Fed to cut interest rates, we expect the companies we invest in to make more money. So we're going to buy more shares of them, and vice versa. If the Fed is not going to cut interest rates, if the market perceives interest rates to be too high, they say, oh crap. There's going to be less employment. There's going to be less money to buy stuff. That means there's going to be less earnings on companies, and that's bad for stocks. So that is pretty straightforward and thorough explanation, but it's not one that I think a lot of people think of. Now, as far as inflation goes, with a lot of things that happened since COVID, a big part of that was supply chain factors. But that's not the only part of it, but it is kind of a big part of it. When companies have a hard time getting components that they need to build stuff, like if you're building houses, if you can't get wood or you can't get nails and that kind of thing because it's on a slow boat from China and it's stuck in a harbor somewhere because everybody in that town had COVID. Well, you have to pay, they have to pay extra for stuff, and they have to charge people more for those houses. The same can be said about any industry, not just housing, but any industry. So mainly the supply chain debacle caused inflation to go up a great deal. Now, that is why the Fed has raised interest rates to where they are now, which is 5.25% to 5.5%. That high interest rate has caused inflation to come down. And we're getting closer to that 2% target. That is the Fed's goal, to have 2% inflation. We're getting close. Now, on the other side of that, hiring is slowing down. Remember, these are two sides of the same coin. Now, how much has hiring slowed down? Well, let's take a look at that. This is a chart from the Bureau of Labor Statistics. And this is the unemployment rate going back 20 years. So, we started here now. Oh, what happened here in about 2008? Well, that was the great financial crisis, right? Unemployment went up to 10%. That's when they cut interest rates drastically. They got them down to 0 to 0.25. And then they started raising interest rates a little bit here, but then we get slapped in the face by COVID. And there's great unemployment for all the things that we just talked about. But that was pretty short. And lockdowns contributed to a lot of that too. But the lockdowns only lasted for so long. And so unemployment abated. People went back to work. A lot of people went back to work quickly. It took some people a longer bit of time. And then the economy got really, really hot. very low unemployment. In fact, the lowest in 20 years in 2022. But with those high levels of interest rates, well, the low unemployment was 3.4%. Fed has a target of around 4.1% or something like that. Started creeping up from 3.4%, which was January 2023, and now we're up at 4.2%, which you might think, hey, you know what? That's okay. I mean, we're pretty close to the Fed's mandated target for unemployment. What's the big deal? What's 0.1% or so? Well, here's the rub. It's what is called the lag. So it can take 6 to 12 months for interest rate changes to take effect. Now, that's a weird figure. And again, if you're going to trade the Fed announcement successfully, you really need to understand this. With it, like if the Fed cuts rates, like let's say, well, we'll talk more about this in a few minutes, but if the Fed cuts rates aggressively now, there's not going to be a lag on the stock market because the stock market prices in future earnings expectations. So the stock market could go up quickly that day. But then companies that borrow money, their borrowing costs go down. And so they can start borrowing money. And then they can start the hiring process. And then those workers can be more productive and they can make more plans and they can make more stuff. And 12 months later, they're selling this stuff and things are going great. And people are buying it because there's higher employment. That takes 6 to 12 months. And for things to really take effect, it can take more than 12 months. Now, that is part of the reason why we hear in the news, if you pay attention to this stuff, that people have been calling for interest rate cuts. We need interest rate cuts right now, which in the beginning, when they started talking about that in January, seemed a little bit aggressive. But that chorus has gotten louder recently, and that's because we're starting to get above the Fed's mandated unemployment level. And if it's going to take 6 to 12 months, we could get into a point where there's too much unemployment, which causes a recession. Now, what the Fed has been trying to do is pull off a miracle. And by golly, there's a chance they might do it. I like to call it the immaculate disinflation, which is to cut interest rates, to keep interest rates high enough to let inflation go down, but time it so that they cut enough to keep unemployment where it should be. Very, very tight balancing act. And there's a whole bunch of armchair quarterbacking and, people saying, well, the Fed should do this, the Fed should do that. Now, look, man, whatever you think about the Fed or, blah, 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 these are some of the most educated economists in the world. So, we can armchair quarterback them somewhat, but they got a very hard job. And I think they're trying to not mess it up. So far, so good. But the question becomes, was it too late? Too little, too late? Should they have cut interest rates sooner? So we're going to find out because it's going to play out over the next 6 to 12 months. Now, that brings us to the moment of truth, this big confluence of what everything for the last couple of years, arguably for the last 4 years, was all leading up to. This Fed announcement, the most important Fed announcement in a couple of decades. Now, at the Chicago Mercantile Exchange, they trade the Fed funds contract. Now, you can look at those futures prices and you can extrapolate from them what the market thinks the Fed might do. So as of Friday, September 8th, there was a 71% chance of a 25 basis point cut and a 29% chance of a 50 basis point cut. And if you don't know what the word basis point means, that's 0.25% or 0.5%. So they're pricing in zero chance of no cut or raise, obviously, and zero chance of more than 50 basis points. So this is where we live here. A little over a 2/3 chance, almost 3/4 of a chance of a 25 basis point cut. Now, remember, I said what markets do is they price in expectations of the future. So let's talk about this idea of priced in. So traders make bets on the future. Now, look, I'm a word guy. Like I said, I wrote a couple of books. I write articles all the time. You know, I'm into music. Words are really, really important. And I always, like search for the perfect word to say things. And I probably don't have the perfect word here by saying traders make bets on the future. I mean, you could call speculative trading a bet, but, some of it is investing as well, which, while there is some commonality between gambling and investing, they are distinctly two different things. But traders make, for lack of a better word, bets on the future, and expected information gets priced in. Now, I kind of described already this idea of, with investing in stocks, they price in future earnings, their expectations for future earnings, but they're also getting even further ahead of that. There's iterations ahead of that. And so what they're also pricing in is what they expect the Federal Reserve to do, because that affects earnings. So that information also gets priced in. But here's the rub. Economists, like the greatest economists in the world, historically have come from the University of Chicago. But those are sort of the classical economists. And classical economics says that markets are efficient in pricing in this information. So basically, whatever price a stock is trading today really is the value of the company, given the information that's available to the people making the decisions to buy or sell it. And the buyers and sellers, supply and demand, gets it to the price, and that's the right price. But as the story of economic academia unfolds, turns out that markets are not really strongly efficient at pricing in information. They're somewhat, they're on the right track, but not really efficient. And, when we see bubbles and that kind of thing, that is proof positive that markets are not strongly efficient. So we also have this thing called buy the rumor, sell the news. Now, we've been reading in the news, people saying, oh, the Fed has got to cut rates. And ironically, when the economy started doing worse, even though unemployment was as low as it's been in 20 years, when the economy started doing a little worse and unemployment got worse, higher, but still good, that's when traders would buy stocks. because, hey, the Fed's going to see this. They're going to realize it's 6 to 12 months that information, that the interest rate cuts get priced in. So they're going to get aggressive. They're probably going to cut rates soon. We could have that immaculate disinflation where inflation goes down and it doesn't put us into recession. So by the rumor, like just these hints that, oh, look, the economy is doing a little bit worse, but it's still strong. The Fed's going to get ahead of it and they're going to cut interest rates, buy stocks. Okay, so that's been going on for a while. But as of September 18th, the rubber actually hits the road. That is no longer the rumor. It is believed by just about everyone in the market that the Fed will indeed cut interest rates next Wednesday. So that is the news. Now, stocks have been, by some metrics, overvalued. If you look at the PE ratio of stocks and the forward PE, well, maybe not so much forward PE ratio, but the PE ratio of stocks, it's been at pretty historically high levels recently. And that's because we've been seeing a lot of this by the rumor. And so what can happen is that if the Fed cuts interest rates, the stocks could actually sell off. And we'll talk more about that in a minute. So here's how we plan for this rate cut. First thing that you have to know is that I'm an options guy. That's all I've done with my entire life for the past, geez Louise, like 25, over 20, 30 years actually. Oh my gosh, I'm freaking old. That's all I've done with my life for like almost 30 years. Over 30 years. And the reason for that is because option traders can profit in any market environment and any direction. Now let's talk about direction, because with option trading, we have to think a little bit differently about that word direction. With option trading, there are actually 4 directions that we can have. A stock can go up, a stock can go down, a stock can trade sideways, and the stock can be volatile. Now, there are option strategies that can capitalize on any one of these things. Now, recently, we've had a very interesting thing going on in options from the perspective of volatility. And it's something that I talked about in our daily video. I put out a daily video to the YouTube subscribers that we have. And I would encourage you to go to YouTube. You can do it right now if you want. Just don't turn off this webinar. Go to YouTube and search Market Taker Mentoring and hit subscribe. And then you can go in and click, there's a gear somewhere. I think maybe it's up here, or no, there's a gear somewhere where you can set to get notifications so that every day when I put out a video, you get a little pop-up on your phone that says, oh, Market Taker Mentoring just put out a video. Now, in those videos, I've been talking about a couple of nuances that ended up working out pretty well. But let's talk about what those nuances are. So a week ago, 2 weeks ago, 3 weeks ago, we had a situation where implied volatility, and I've talked about that in a previous Firstrade webinar. Go back and listen to the series on the Greeks that I did about a month and a half ago. The implied volatility, which is basically how cheap or expensive options are, was very, very low compared to how much stocks were moving. Now, that is a rare situation. That does not happen all the time. In the long run, historically, since the crash of 87, on average, options have been overpriced. That's why sometimes you'll hear people say the only way to make money in options is by selling them. If that's what you have done on average, that would probably be accurate, with a little bit of variance involved there, of course. But we're in the opposite period for a few weeks where implied volatility, where options were undervalued, not overvalued, right, for selling, but undervalued. And it became an incredible opportunity to buy straddles. And in hindsight, you see that would have worked because the market volatility actually picked up even more. And we see the VIX rising, and implied volatility has now caught up with it. Now we're back as far as volatility pricing, market efficiency. See, sometimes it's not. It's never really efficient, but we're back sort of to that mean reversion scenario. We're in a more normal situation. So the strategy needs to be changed. And I talk about those in our daily videos also. So again, please go to YouTube, search Market Taker Mentoring, click subscribe, and make sure you're getting notifications. All right. So what do we do going forward? How do we trade the next Fed announcement? Okay. Volatility is no longer overpriced, but one possibility is that straddles are still possible leading up to the announcement. And that's because there are two price influences on straddles. Here's how straddles work. There's two parts to it. One is if the stock moves a lot, you can make money on your straddles. Now, if you ever read anything on straddles, saw a V-shaped P&L diagram on straddles, like that's intuitive. That's what they teach you in the textbooks. And so if the market moves around a lot between now and the announcement, great. Straddles can be profitable. But the other part of that is at some point, straddles become so expensive that you need massively more movement in order to make money. So straddle traders have a hard job, and straddles are difficult to trade. And by the way, for those of you who are not familiar with straddles, that's when we buy a call and a put on the same stock, and they have the same strike price. So basically, you make money if the stock goes up a lot, you make money if the stock goes down a lot. And if it goes back and forth and you're hedging, you can make money just on the volatility itself. So it's difficult to trade straddles because we're always balancing these. Hey, are we getting enough movement? And is the straddle overpriced or underpriced? Now, what's most likely to happen going forward, straddles would be a challenge. What's most likely to happen going forward is some mini trends. And I just talked about mini trends in our video yesterday. So for those of you who do subscribe to YouTube, you're going to hear what I had to say about that. And when I say mini trends, I'm not saying like super mini. We've had some pretty good moves up and pretty good moves down lately. That's the most likely scenario. So if the Federal Reserve cuts interest rates by 25 basis points, and mind you, I'm someone who has studied the market for 30 years, but I don't have a crystal ball. So I'm giving you my educated guess here. And I believe my educated guess. If the Fed cuts interest rates 25 basis points, probably what happens is we get some of that sell the news. The market could sell off. Best case scenario, we get what's called a dead cat bounce, which I realize if you're a cat person, you might not like that phrase, but it's a market idiom. I didn't make it up. But a dead cat bounce is when, like, well, if you throw a dead cat, like it just kind of, right? It doesn't really bounce. So the market could just kind of sell off a little bit and or just sit there and wait, because the Fed is just sort of cutting interest rates to the point that they need to cut interest rates and not going forward and doing more. And so the story continues, and there will be expectations to cut interest rates the next time and to cut interest rates the next time. And we just keep in this cycle that we're going on, and the market, is going to kind of roll their eyes and sigh and say, oh boy, well, I got to keep doing this. So yeah, the most likely case scenario is either sell the rumor or the market just kind of sits there. If the market cuts 50 basis points, I believe that the most likely scenario is that the market rallies. Why? Well, because if you go back to what the CME Group's Fed funds contract was pricing in, only 29% of people believe that the Fed is going to cut by 50 basis points. That's the minority view. And so if that happens, that's going to catch 71% of people off guard, and they'll be like, oh, wow, that's a surprise. That's good. The Fed's really getting aggressive. We're going to have this immaculate disinflation. So I believe the most likely scenario, if the Fed cuts 50 basis points, is that the market rallies. Now, if the Fed says, well, we need more data, and doesn't cut, which the Fed funds contract prices in a 0% chance of that happening, I believe that would lead to a very sharp sell-off, because that would catch everybody by surprise. And I believe that most economists would think that unemployment is going to keep rising and the Fed didn't do enough fast enough. All right. So what happens after the announcement? Well, the first thing to know is that Jerome Powell always gives a little speech after the announcement, and that tends to drive temporary volatility. As soon as the number comes out, is it 25 or 50, the market may move, probably a lot if it's 50. Who knows if it's 25? But that's only part one. Then Jerome Powell starts talking, and he starts talking about what the rationale was in that decision, what the Fed believes they have to look at going forward. And then all the economists at all these big houses like Goldman Sachs and all these other ones, they're going to say, oh, well, the Fed thinks this, and I'm going to armchair quarterback them. And an analyst at Goldman Sachs has a better chance of armchair quarterbacking than most people in the world. And those companies have a lot of money, and they put their money where their mouth is, and they create supply and demand pressures. And so thus, we will see the market moving higher or lower based on what Powell says after the announcement. Now, the next thing you need to know is implied volatility tends to be high leading up to a big announcement like a Fed announcement. Quick quiz. Who can be the first to tell me, what does implied volatility mean again? Just in a couple of words, like the big picture, not the textbook definition. Hit that quick Q&A box. What does implied volatility really mean? What is it? Try and keep it fewer than 5 words, really tight. Who's first? Come on. This is for honor and glory. What's better than honor and glory? Well, maybe winning trades, right? But nobody, I actually gave you this answer earlier. Somebody's going to do it. Honor and glory. I know I get a lot of repeat viewers here. There we go. Jeff says, so good. That is a perfect answer, Jeff. Yeah, let's hear it for Jeff Z. Cheapness or expensiveness of options. That is exactly how I define it. Cheapness or expensiveness of options. So what that means is that going into the Fed announcement, people are going to be buying straddles. More novice traders are going to hold straddles through the announcement. I'll tell you why in a second. And people who own shares of stock, they're going to be buying puts to protect themselves because, you know, if some surprise that there's zero cut or maybe just 25% basis point cut, stocks go down, people are buying puts to trade that. Or people who don't have a position but really believe that there'll be a 50 basis point cut, you know, they might not want to buy the stock and risk losing a lot if the market, you know, tanks because there's no cut. So they'll buy calls that have limited risk and they can make money if they're right. So there's a great deal of demand for options going into a big, hugely important announcement like this. So options are more expensive now. Synonymous way to say that is implied volatility is high now, and it's likely to get higher as we get closer to the announcement. But here's the rub. The next thing to know is that implied volatility tends to crush after said announcement. What do I mean by crush? Well, just like it sounds, goes down and goes down fast. As soon as that number comes out, some of the volatility will crush. But then as Powell talks for the next hour or so, the trading will happen, the profits or losses will be taken, and all those options that were purchased get sold. And the supply pressure comes in. And implied volatility goes down very drastically, typically over that next hour. So, a warning for people who consider straddles, they seem like such a great thing when you look at the textbook V-shaped P&L diagram, but it's not the whole story. It's also the implied volatility component. So for me, I wouldn't be holding a straddle through the announcement. Right now I'm out of town, have a family situation. And when I'm out of town and have a family situation, I know I can't be in front of my computer all the time. I don't put trades on. But if I were, and if I decided to trade straddles, they would be to trade between now and the announcement, not through the announcement. So let's talk about some trade considerations. Again, straddles held through the announcement likely lose value after the announcement, unless there's just such a massive move that it doesn't matter how much you paid for the straddle. And that becomes a pretty unlikely scenario. But like I said, many traders are going to plan to take profits on straddles before the announcements. Now, here's the thing that I have seen working in names like AT&T, Apple, Google recently, and that's directional trades. Mini trends, like I talked about in our video yesterday on YouTube. Directional trades, first of all, they can be choppy. Choppy is like, it's up, no, it's down. Up, no, it's down. But we have been seeing trends that last, 5 or 6 days or so. In some cases, 10 to 15 days. and they can be pretty fast and furious. Take a look at AT&T or Apple or Google recently. There's some excellent, excellent opportunities for these mini trends that I've been talking about. Volatility selling opportunities can capture volatility crushes, but they can be risky. Like many people like to trade, they stick by that, saying the only way to make money in options is by selling them. And it can be very, very tempting when options become expensive because implied volatility is high. And there can, in a theoretical standpoint, be an edge to it from that regard. But the other side of that is if you get a big move and it moves the wrong way, you can really get hurt, because when we sell options, even if it's part of a spread, we have greater risk than our potential reward. So those are possible trades, but they can be risky. And so traders need to really, really pick their spots very carefully if you're doing things like selling credit spreads. All right. Now, I brain dumped a ton of information on you. I wanted to make sure that the folks watching this presentation were very, very educated going into this Fed announcement and can make really great trading decisions of your own. So if there's any questions that I can answer to clarify anything, now's the time, folks. Hit that Q&A box, drop your question in there, and I will be glad to give an answer. Yeah, this is an exciting Fed announcement. Boy, oh boy. I mean, such a confluence of so many factors over so many years that have led up to that moment. It's going to be a historical moment that people talk about for a long time. The last time I can think of a Fed action that had more impact and was more historical it wasn't actually a Fed announcement. It was when Greenspan surprisingly raised interest rates 75 basis points in a week, not during a Fed announcement. That was, oh my goodness, when was that? That was like year 2000 or something like that. It was a long time ago. Fabian says, would selling a far out of the money iron condor and closing it just before Powell opens his mouth going to fund my new yacht to capitalize on the IV crush? Well, Fabian, as they say, got a hunch, bet a bunch. Hunch is wrong, bunch is gone. So it's possible, but I am definitely not going to advise you to do that. And holy cow, what NTIS? I don't know if those are initials or you dropped something on the keyboard when you logged in here or what. I don't know if there's maybe that's an actual name. I'm not sure. Thanks for your info. Question: what are your thoughts on 0DTE credit spreads selling on SPX these days? Oh, my friend, you were talking about something that I love to talk about. I think next time I give a batch of presentation concepts to Firstrade, I'm going to do one on 0DTs. That's one of the things that we specialize in at Market Taker Mentoring. If you're doing credit spreads, that is, especially these days, 0DTE is the best way to do them. And we actually developed a tool that identifies professionals trading big credit spreads going into that are 0DTEs. And I don't know if you're aware of this, you probably are if you're asking this question. SPX options now trade, I don't know if it's quite 24 hours, but they trade before the market open. And so if you have the right tools and you can identify these things, you can see what the big money really thinks is going to happen, and getting on the same side of that sometimes can really work out great. I mean, the biggest advantage to zero DTE trading, but if I didn't say this already, zero DTE means 0 days to expiration, which means you put on the trade today, it expires at the end of the day. The biggest advantage to zero DTE trading is that there's no overnight risk. You put it on today, the trade is off at the end of the day. You close it or it just expires, it's gone. So if there's a surprise overnight gap like we've had a lot of recently, you don't have that risk. So yeah, man, great question. I love it. Yeah, I love zero DTE trades on SPX. Okay, great questions. Thank you for sharing your time with me, and I hope that the things I shared with you are helpful to you and keep you prepared and armed to trade this next Fed announcement. Thanks. So will you be giving training on zero DTEs? I will propose to Firstrade a zero DT training. I think I've got the next month of them already booked up, but after that I will. I mean, we do a bunch of training with Market Taker Mentoring on those, but I'll try and do one with Firstrade. Probably be a month or so from now. But yeah, all right, great questions. Have a great rest of your day. Trade smart, and I'll see you next week. Bye.